Hello and welcome to Unacademy, a one-stop destination for all the English medium civil service aspirants. Welcome to the final lap, and in the final lap initiative, today we'll be discussing the important ratios as well as the graphs for the upcoming civil services examination. Now before I start the discussion, two very important announcements. The first one, in order to assist the students who are appearing for the upcoming civil service examination, earlier we ran an initiative called as Conquer Prelims. In the Conquer Prelims, there were two parts. One, taking care of the static portion, and the other one, taking care of current affairs. In addition to those two, in this week, we are going to run the idea or the concept of the final lap, wherein for revision, we'll be taking up certain concepts. Already the concepts have been taken by Chetan sir. History related concepts have been discussed by Abhishek sir. Today I'll be taking up certain important areas such as ratios as well as the graphs. Tomorrow Mukesh sir will be taking up certain important concepts, and then Sarmat sir will also be taking up the polity initiative. That's the first one. Second one, if you are a student who is aspiring to write the civil services examination next year, 2025-26, for those students, we have launched 15 months subscription course at an offer price of 29,999 rupees. The top educators in Unacademy will be taking your classes. The English course Arambh, English course Triumph has been launched from 8th June. English Arambh will be launching tomorrow, that is 12th June. If you are interested, the number is given here, and also the link is given in the description. Please do check out. Now before I start, if you have got the benefit of these initiatives, please hit the like button, and if you have to subscribe to our YouTube channel, kindly do it now. Now let me start the discussion. The first very important ratio. The plan of the class is very simple. First we'll discuss certain important ratios, then I'll take up certain important graphs as well. But before I start, the area of ratio has become very famous in recent times in the civil services preliminary examination. The UPSC has the habit of picking up one ratio somewhere from the current affairs and asking that as a question. Now to be very precise here, there are multiple ratios. There are more than 40 types of financial ratios itself. Will you be able to remember all of them? Not possible. Should you memorize all of them? Should you understand all of them? Not required. So what I've done is, in the last 1.5 years, whatever graphs, whatever ratios have appeared in the current affairs, in the newspapers related to one company or the other company, etc., I've picked up those particular ratios. Now let's start. The first one is market cap to GDP ratio. What do you understand by the term market cap to GDP ratio? It is basically the ratio comparing the market capitalization to the gross domestic product of a country. But why is this important? Why is this relevant for civil services? Market cap represents the market capitalization, or essentially what is the market price of all the shares which have been issued by the companies which are listed in the stock market. For example, in India, Infosys is a listed company. There are multiple companies such as Tata company, which is a listed company. Paytm is a listed company. So whenever you have a listed company, it would have issued shares in the market. Now what is the market price of the share? Take that, multiply with number of shares. What you get is market capitalization. And the term market capitalization has been there in the discussion. Please be very careful. Market capitalization crosses 4 trillion, 5 trillion, etc. These are there in the current affairs in the last 1 year. Now, what is the importance of market cap to GDP ratio? There is a concept called as overvaluation and undervaluation. Now, whenever you come across the term overvaluation or undervaluation, this is generally discussed in the context of shares of a company. It is discussed in the context of a company. But here, when you are talking about market cap to GDP ratio, we are trying to find out whether the whole market, that is a particular economy, the whole market, whether it is overvalued or undervalued. And remember one more name for this particular GDP ratio or market cap to GDP ratio. It is also referred to as Buffett indicator. Buffett indicator, named after one of the wealthiest investors in the global market, Buffett indicator. And what is the importance of this? If the market cap to GDP ratio keeps on increasing unnecessarily over a period of time, let's say from 90%, it will increase to 100 to 120%, 140%. What does it generally indicate? It indicates that the market price of the shares have started increasing, and with the rise in the market price of the share, market cap increases and the M cap to GDP ratio also increases. And generally this rise, a sudden rise in the M cap to GDP ratio is taken as an indicator of overvaluation in a company or overvaluation of an economy. But please remember this, when you're talking about M cap to GDP ratio, you're talking about only the listed companies. You're talking about the companies which are listed in the market. The unlisted companies' valuation is not considered here. So that's the reason. And please remember this. If your M cap to GDP ratio keeps on increasing, hits 140%, 150%, it's an indicator that if there is a crash, because the market will correct itself. If there is very high valuation of a particular asset, the market forces will force the market to correct itself. And when the correction will happen, the market will crash. And that has happened earlier in the history of economic evolution in various economies. That's the reason M cap to GDP ratio, if it is more than 100, 120, 140, 150, there is a concern regarding overvaluation of a overall market or overall stock market in the economy. And why this was there in the newspaper? Precisely because of India's market capitalization hitting 4 trillion, 5 trillion, etc. So what is the importance of the ratio? It is used to find whether the whole market is overvalued or undervalued. And there have been instances where the market, whenever it is overvalued, market has crashed. And so remember this particular indicator, the first very important current affairs ratio. Now, whenever the market caps keeps on increasing, I told you this, just a reiteration. Whenever the market caps keeps on increasing, I hope you remember this particular picture, you will have to understand that there will be a correction. There is some events which are happening in the market, enthusiasm amongst the investors, which is pushing up the market capitalization. So there is something wrong. Now next indicator, volatility index, VIX, volatility index. Now volatility index was discussed in the context of recent election outcomes, again not in the elections but in the stock market. But even before that, some of you will basically ask me, sir, if it was discussed very recently, will it be asked by UPSC? Understand the point here. It was not that it was discussed only in recent times. Even during pandemic, after pandemic, multiple times the concept of volatility index or VIX was there in the discussion. Now what is this volatility index? It will measure the volatility in the market in the short term. Essentially it means the National Stock Exchange, because in case of India, NSE publishes volatility index. NSE publishes volatility index. NSE is basically telling you in the next 30 days, what kind of expected movement is going to happen in the market. Again, please understand, it is expected movement in the market. Now you will be having a doubt, sir, how is that possible? How can you measure what is going to happen in the market? The reason is simple. In the derivative market, there is a market called as options. If you look at what kind of orders have been placed for options, you will realize that. And those who are wondering, sir, what is options? What is a derivative, etc.? Do not worry about it right now. Understand the logic here. So in case of option markets, if you look at what kind of orders are getting placed in the options market, you will realize whether the market is expecting the decrease or the rise in the prices of certain, let's say, underlying assets. That is basically the argument which is taken into consideration by National Stock Exchange to arrive at a volatility index. But to be very precise here, NSE, it has not originated, it has not created a volatility index. Volatility index was basically created, or let's say the idea or the concept was originated in USA by Central Board of Options Exchange, CBOE, Central Board of Options Exchange, that is Chicago's Central Board of Option Exchange, and along with S&P, Standard and Poor Credit Rating Agency, Standard and Poor, these agencies have given this concept of volatility index to be used on lease basis by NSE. So this was there very recently in the newspaper, and whenever the volatility index is very high, whenever the volatility index is very high, it indicates that in the coming days, volatility in the stock market will also be higher. And this was there in the current affairs for the last 2 years. Please be very careful. UPSC has not asked a question regarding this so far. Now next one, earnings per share, EPS, earnings per share. Now what is the formula for earnings per share? I am entering into financial ratios now, very typical financial ratios. EPS stands for the total income generated by the company divided by outstanding shares. Now before I start discussing, I know some of you will be purely from the commerce background. Some of you will be from the management background. You will try to correct me and say, sir, when you write net income, you should have written this way. When you write outstanding shares, it is not simply outstanding shares, it is outstanding equity shares, etc., etc. My dear, for those of you, understand the point, I am discussing this for Indian Economy GS Paper 3. The technicalities of all these formulas, that will not be required for GS Paper 3. Just understand the concept behind that and you should be able to answer, if at all, any kind of a conceptual questions or statements are asked by Civil Services examination. Now, what do you understand by the earnings per share? It essentially will tell you how many equity shareholders are there. And those of you equity shareholders, those who are wondering, sir, what is this equity shareholders? Equity shareholders are those shareholders who are classified as basically one type of shareholders apart from, who are different from preference shareholders. In case of preference shareholders, a guaranteed amount of dividend, a fixed amount of dividend is given to the preference shareholders. Whereas equity shareholders, the dividend will vary and it depends on how much profit the company is earning, etc. So what does the EPS basically mention, or what does it provide? What is the information that you need to understand? EPS basically tells you every shareholder, again equity shareholder, every equity shareholder, how much is the earning done on the share. For every equity shareholder, how much is the return provided by the company in the form of, let's say, the earnings, in the form of returns to these particular shareholders. And what is the importance of EPS? Remember this, EPS should not be volatile. I repeat, EPS should not be volatile. EPS should be stable. And for an investor in the market, again, I am expecting this would be useful in the UPSC. That's the reason. For the investor in the market, whenever you look at the EPS number, EPS should keep on increasing over a period of time. If you want to invest in such a share of a company, EPS should not be very high in 1 year, very low in another year. Right? The volatility in the EPS is not preferable. Stability is actually preferable. And if the EPS is continuously increasing for a company, that is also preferable. Done? So in a nutshell, this is basically the idea of a EPS. Now related to EPS, there is one more concept. And while I am discussing these in groups, please understand, there are multiple types of ratios. Some are called as solvency ratios. Some of them are called as activity ratios. Some of them will be referred to as the turnover ratios, etc. But you do not have to understand the classification. You need to understand what is the connection, where can you use it, where it was there in the newspapers. Next one is return on equity. That is basically ROE means the profit earned by the company divided by equity held by the company. Now some of you look at both of these, that is basically the EPS as well as ROE, and come to a conclusion both are one and the same. Right? Just like you assuming that this as well as this both are stories about or movies made on Ramayana, both are one and the same. And all of you know by now both are completely different. Apply the same logic to the previous argument. The return on equity is different and earning per share is different. How so? Return on equity is provided as a percentage, that is out of 100 how much? As a percentage it is provided. For example, let me give you a basic idea here. Imagine there are two companies A and B. There are two companies A and B. A has earned a profit of let's say 100 CR and B also has earned a profit of 100 CR. Now if I ask you, in which of the shares, A is a share or B is a share, would you want to invest? Many of you will basically ask me, sir, what is the importance of this? How should I determine this? Because both the companies are earning same amount of profit. But the argument is very simple here. What if A is earning 100 crore but the capital is 1000 crore and B is earning a profit of 100 crore but the capital is simply 500 crore. So the investment that is done, the capital that is done by the equity shareholders is different here. This is different, and most of you now should simply say, sir, in that case I will invest in the shares of company B. Now what is the use of this? What is the use of this? Understand this carefully. Higher ROE is actually preferred. Higher ROE is actually preferred, which means for every capital that you are investing, for every 1 unit of capital that you are investing, if ROE is higher, and again, sir, why are you talking about capital here? My dear, if you are a shareholder, that too an equity shareholder, your investment, you are the owner of the company, your investment will be used for capital purposes. So every unit of investment that you do as an equity shareholder, if that investment is done, how much is the profit earned by the company? That is basically the return over equity or return on equity. And remember this point as well. The performance of the companies cannot be determined based on only one parameter. You will have to look at ROE, you will have to look at other indicators, and many of the times investors use many of these indicators. The market experts use many of the indicators to determine what is the performance of the companies, what is the use of this, etc. Before I go forward, some of you still would be having this kind of a doubt. Sir, is it needed for UPSC? Should we read all of this for UPSC? Please check the question papers. In the last couple of years, there is a rising trend in the UPSC to ask these kind of questions. For example, there was a question earlier on the concept of coverage ratios. What is the meaning of a higher coverage ratio, lower coverage ratio? Last year, there was a question on the financial volatility or financial market volatility by the term beta. You will not come across these concepts in a traditional book, but in the last 1.5 years, whatever is there in the newspaper, you will have to be focused on that. So what is the importance of higher ROE? Higher ROE basically means the investors, that is the company's owners, that is the equity shareholders, are earning more amount of returns on their investment. 10%, 15%, 20%, 25%, that is very good. Higher amount of returns essentially means, right, higher amount of ROE essentially means higher returns earned by the shareholders. It also shows how efficiently the capital is being utilized by the company. The company is collecting capital. It is issuing shares, collecting capital. But how efficiently is the company utilizing this capital? That is indicated by higher ROE, return on equity. I hope you have understood now. Both are different indicators. ROE is a different indicator. It will give you certain information regarding performance of a company. EPS, earning per share, is also a different indicator, gives a different, let's say, the result regarding the performance of a company. Okay, now, next type of a ratio, important. Very often in the context of, let's say, companies which were there in the newspapers, for example, Adani group of companies, Reliance group of companies, this particular term has been mentioned, especially in the last 1.5 years. Price earnings ratio, PE ratio, price earnings ratio. Please look at the formula first. PE ratio basically is provided by market price dividing the earning per share. And some time ago, hardly around 5 to 10 minutes ago, we have discussed the concept of earning per share. In fact, the EPS, earning per share, is used in multiple formulas to calculate and get the outcome. Now, what do you understand by the term price earning ratio? What you should remember, what is the inference of it and how it is calculated? You take the market price of a share and you divide that with the earning per share. But what does it actually mean? Imagine you are paying 100 rupees to purchase a share of a company, and the share of the company, the earning per share is let's say 10 rupees, which essentially means by paying 100 rupees, can I simply say you are getting a returns of 10 rupees? I hope you understand. If you are paying 100 rupees, you are getting a returns, earning per share, that is the returns of 10 rupee. That is basically the formula of PE ratio. But some of you will ask me now, or will have this kind of a doubt, sir, why should I pay 100 rupees to get a returns of 10 rupee? My dear, please do not come to a conclusion based on only the EPS here. Please do not come to a conclusion based on EPS. It also means the market price of the share in the future might start increasing. All of you will agree with me? The market price of the share today, it is 100 rupee. It might start increasing in the future. And that if you sell it in the market or even if you hold it, the share that you have purchased, the value has appreciated, your wealth value has also increased. So please do not make a decision based on only the number 10 rupee here. But essentially, what does the ratio indicate? How much money you need to invest in order to get returns. In this case, if you invest 10 rupees in the company, you will get 1 rupee in return. That is the importance of price earning ratio. Now, many of you will come to a conclusion based on this. Sir, then what I would require is a lower price earning ratio. That is basically you will come to a conclusion based on this information. I will invest 1 rupee and get 1 rupee. That is the best outcome for me. Or I'll invest 1 rupee, get 2 rupee. That is earning per share. This I would prefer, etc. But my dear, the market doesn't work that way. The market doesn't work that way. Now, some of you will be thinking, sir, what are you saying? What are you saying? The lower PE ratio, the lower PE ratio is preferable for the investor. I'm investing 1 rupee and I'm getting 2 rupee in return. I'm investing 1 rupee and I'm getting 5 rupee in return. This is a low PE ratio and I would prefer this. But my dear, please understand, generally in the market, whenever the PE ratio is higher, it indicates one of the two things. If the PE ratio is very high and unnecessarily, I hope you understand, unnecessarily, without any reason, without any argument, if the PE ratio is increasing very fast, generally is an indicator of overvaluation of a company. Overvaluation of a company. Right, point number 1. So, if the PE ratio is very high without any reason, without any rhyme or reason, without any argument, fundamental change in the market, then it is an indicator of overvaluation. If the PE ratio is very less, it is an indicator of undervaluation for a share. This is one point you need to remember. These kind of terms are used in the preliminary examination. Point number 2, if understand this, in that case, some of you will basically say, sir, I won't prefer a higher PE ratio. I would prefer a lower PE ratio such as 1/5. That also doesn't happen in the market. Reason being, you yourself ask this question. If any company is giving a return of 5 rupees to you, don't you think the demand for the shares will start increasing? Correct? The demand for the shares will start increasing. And when the demand for the shares will start increasing, do you think market price will remain same 1 rupee? No, market price will start increasing. That's the reason whenever the PE ratio is also higher, one of the indicators is that the market has very high confidence on the company. I repeat, the market has very high confidence on the company. And when the market has very high confidence in the company, their investments or the demand for the share will start increasing, and when the demand starts increasing, the market price will also start increasing. But there is a reason behind this. There is a reason. What is the reason? Reason is you are expecting the company is performing very well. You are expecting the company to earn more profit and return to the investor, etc. And that you will come to know looking at other indicators of the company or related to the company. That's the reason. Please be very careful. Higher P ratio, that is price earnings ratio, if there is no reason, no argument whatsoever, rational argument regarding that, it means the shares are overvalued. And if it is very less, it is undervalued. Undervaluation means what? Imagine instead of 100 upon 10, it is 100 upon 5 rupees. Sorry, 100 upon 15 rupees. If the P ratio is lesser, it also means the company which is giving you 15 rupee in return, it is not able to leverage that and get more money from you. I hope you understand. The company is giving more returns to you. Earning per share is 15 rupees. But the company is not able to leverage that, raise more and more money from the investors. That is undervaluation. So undervaluation, overvaluation. Higher P ratio would mean that it is overvalued, or the investors are expecting better growth in the coming days related to the company. This is basically the meaning of P ratio. And some of you would be asking me, sir, which is a preferred number? Is P ratio 1, is it preferred? A P ratio 5, is it preferred? Please understand, from one company to another company, from one industry to another industry, the numbers will keep on changing. That's the reason in some of the cases, for example, P ratio, some of the industries will have an average of 20, which means, right, basically it is 1 rupee, you will get returns by investing 20 rupees in the share of a company. So from one industry to another industry, it will keep on changing. There is no fixed number for many of these indicators. Yes, there are certain indicators. For example, there is an indicator called as current ratio. There is an indicator called as interest coverage ratio. There is a ratio called as a debt to equity ratio. There are certain numbers which are generally provided. But for others, there is no fixed number. It will vary from one industry to another industry. What generally is used in the market, not used for UPSC, used in the market is you compare with their competitors. You compare with the competitors, then you will realize whether the price earning ratio of one company, is it overvalued or undervalued? The EPS, is it better or worse compared to other competitors, etc. Now, let me go to the next one. Price to book ratio, PB ratio, price to book ratio. Price to book ratio, basically it's a ratio of market price divided by book value of a company. Again, technically, not complete formula, because in the context of book value, I need to calculate how much is the asset, how much is the liability, how much is the net value of the company, etc. But for UPSC, I don't think so. UPSC will ask you to that particular extent the calculation. So what is the indicator or what is the use of price to book ratio or PB ratio? You will take the market price of the share and you will divide it by book value of a company. Book value essentially is what is the net value of a company, and net value is how much is the difference between the assets as well as the liabilities of a company. And the use of the price to book ratio is to find the valuations of the companies. Valuations. Sir, why are you discussing about valuations? I am preparing for UPSC Civil Services examination. I am not appearing for Chartered Accountant examination. My dear, in recent times, let's say 1.5 years, is there a discussion regarding the concept of startups in India? And startups, whenever they attract investments, don't you think the investments that is done in a startup is based on the valuation? And valuations, one of the ways to find out valuation of a company is price to book ratio. Right? So there is a connection. Whatever is happening in the current affairs, there is a connection to all of it. So price to book ratio, PB ratio. What is the formula? Divide the market price of the share by the book value. It is also referred to as market to book ratio. But what is the use of it? What does it actually indicate? Using this, the valuation of the companies can be determined. For example, if the price to book ratio, look at this, if the market price of the share is let's say 100 rupee, but the book value is let's say 10 rupee, which means the shares are overvalued in the market. The shares are highly overvalued in the market. If valuation, the net value of the company is 10, you are basically paying this particular share 100 rupees in the market, overvaluation. So using this ratio, you will be able to find whether the company's valuation is appropriate in the market or less than that in the market. In fact, please understand this. As earlier mentioned, you do not use these indicators individually. For example, PB ratio, you do not use that individually. You use the PB ratio along with let's say return on equity, ROE. And just think of it. If both of them are increasing like this, that is ROE is also increasing and the price to book ratio is also increasing, it is preferable in the market. And if one is increasing and the other one is decreasing, it simply means that there is something fundamentally wrong with the company's performance. That's the reason the price to book ratio is also one more type of ratio which is used in the market by investors. Can be a potential question in the UPSC preliminary examination. Please be very careful. Now coming to the more famous one, debt to equity ratio. Debt to equity ratio. In fact, this particular ratio was discussed in the context of Adani group of companies. Again, do not worry. You don't have to memorize the numbers regarding that company. Understand the concept. What is the debt? Debt basically means the amount you have borrowed. Very simple. Amount you have borrowed, which you will have to obviously repay. What do you mean by equity? Equity basically represents the ownership contribution or the contribution done by owners. And what is the use of the debt to equity ratio? Understand this carefully. If the debt to equity ratio is very high, sir, what do you mean by very high? Generally, accepted number is 1:1. That is, ratio should be 1. If 100 crore is the owner's contribution in the form of capital, that is equity infusion, the debt should also be 100 crore, which is basically 1:1. But in many of the industries, it is more than 1. In many of the industries, it is less than 1 as well. But what is the meaning of, let's say very high debt to equity ratio? Debt to equity ratio should not be very high and debt to equity ratio should not be very low as well. It should not be very high, it should not be very low as well. But understand the meaning of it. If the debt to equity ratio is very high, it means you have borrowed heavily from the market. You have taken huge amount of loans from the market. And when you have borrowed heavily from the market, there is a repayment liability. Is it okay? You will have to repay these loans. So there is a liability that you will have to satisfy, and that is not considered favorable. For example, imagine a company will come to you, they want to issue a bond and borrow from you. Already their borrowings are very high, their debt to equity ratio is very high, which means the company has huge amount of money to repay. So which is a signal, which is a dangerous signal for the investors. So debt to equity ratio should not be very high. And please understand, when the debt to equity ratio is very high, it is also an indicator that now they will find it very difficult, and even if they borrow, they will borrow at a higher rate of interest because the risk of investing in such a company has increased. Now there is a problem if the debt to equity ratio is also low. If the debt to equity ratio is lower, then also it is a problem. What is the meaning of it? You will borrow and you will repay. You will raise the capital, correct? And on the other side, you will issue shares and raise the capital. Please remember, compared to debt, equity is costly. I hope you understand this. I'll repeat it again. Compared to debt, equity is costly. You are giving ownership away. Debt can be repaid. Debt will carry certain interest. But equity, you are giving the ownership, which basically means if your debt to equity ratio is very less, you are not ensuring that, or you are basically not taking care of your ownership. You have issued lot of the shares in the market. You might have issued lot of shares in the market, which is a costly way to raise capital or collect capital from the market. So if your debt to equity ratio is very high, problem. If the debt to equity ratio is lesser, that's also problem. And already I've told you, the acceptable ratio is generally 1:1. 1:1, again, reiterating the point, it might vary from one industry to another industry as well. So it is used to find how much is the company leveraged. Leverage means how much debt they are able to raise. Higher ratio is not at all preferable. It is not at all preferable in the market. Next one, current ratio and quick ratio. Two more ratios, current ratio and quick ratio. Current ratio formula is current assets divided by current liabilities. Quick ratio, which is also referred to as acid test ratio, quick assets divided by current liabilities. Now many of you will be having a doubt, sir, what is a current asset? What is a quick asset? What is the difference between them? What is this current liability? My dear, if you are running a company, you will have certain raw materials. You have purchased certain raw materials. You will produce and sell it in the market. You have sold already to somebody. They are yet to repay the money to you. So there are different ways that you will calculate your assets. These are the different types of assets. And on the other side, right now you need to pay a lot of your, let's say expenses also. Take care of your expenses. That is your current liability. And whenever you talk about current assets and current liabilities, please understand short term. Short term, right? How much is your asset in short term? How much is your liability in short term? For example, if I purchase raw material, I need to pay in the next 45 days. Short term liability. If I sold a good to, let's say a company, another company in the market, I will receive the payment in 60 days. Short term asset, receivable, trade receivable. So short term assets, short term liabilities. So there are two ratios which are generally used. Again, beyond this, are there any other ratios? Of course, yes. In the beginning itself, I have told you, multiple ratios are there. But based on what is there in the current affairs, here and there related to that company, this company, in the last 1 year, these are the kinds of ratios which have appeared in the newspapers. So current ratio will basically provide you information regarding how strong is the company in terms of repaying its short-term liabilities. Right? How much strength does the company have? What is the capacity of the company to repay in short term its liabilities? That is called as a current ratio. Then what is the difference between a current ratio and quick ratio? In case of quick ratio, imagine the company is not able to sell anything and earn money. So logic is very simple. You purchase raw material, you will manufacture and sell it. But if you are not able to sell this product now, with whatever quick assets that you have, other assets are called as quick assets now. Whatever quick assets you have, how much is the value of that which you can use to repay your current liabilities? That's the reason the quick ratio is a much better quality indicator, and that's the reason this is called as acid test ratio. Acid test ratio. So current as well as quick, used to find whether the company can meet short-term liabilities without any kind of an issue. So how much is preferable? If current ratio generally it is 2:1, which means compared to your liabilities, let's say your liabilities are worth 100 rupees. It also means you have a current assets worth 200 rupees. Easily you can take care of your liabilities. Higher the current ratio, it is preferable. Generally 2:1. And in case of quick ratio, at least 1:1. At least 1:1. Right, so current ratio as well as quick ratio. Now apart from this, liquidity coverage ratio and capital adequacy ratio. Earlier we have discussed certain financial ratios, and one more is there, interest coverage ratio. I will discuss that also. Liquidity coverage ratio and capital adequacy ratio. This is related to banking sector. This is related to banking sector, and within banking sector this is associated with Basel guidelines. Basel guidelines. What is liquidity coverage ratio? LCR. Here is a bank. The bank has to estimate in the next 30 days how much money will flow out. And both of them are part of Basel 3, by the way, Basel 3 guidelines. Liquidity coverage ratio, a bank has to estimate in the next 30 days how much money will flow out of the bank. And at least that much, 100% of that outflow, they will have to maintain in the form of high quality liquid assets. Is it okay? For example, a bank will estimate in the next 30 days, let's say 80 crore rupees will be flowing out of this bank. Then at least 80 crore, underline the term, at least 80 crore, which is nothing but 100% of the outflow. at least 80 crore rupees they will have to maintain in the form of high quality liquid assets. What do you understand by high quality liquid assets? These assets can quickly be sold in the market, money can be generated. Money can be earned by selling these particular assets. For example, government securities. That is a liquidity coverage ratio which has been mandated by Reserve Bank of India on the banking sector. Capital adequacy ratio. This is basically the minimum amount of capital. I repeat, minimum amount of capital that every bank has to maintain in order to absorb the losses. In case of India, that is, let's start with the Basel guidelines now. Under Basel guidelines, it is 8% of risk-weighted assets. And in case of India, RBI has mandated 9% of risk-weighted assets in the form of capital adequacy ratio. Again, within capital adequacy ratio, in earlier classes, we have discussed all of this. You need to maintain tier 1 capital, tier 2 capital. Tier 1 can absorb losses much more, right, easily compared to tier 2 capital, etc., etc. So, capital adequacy ratio, CAR. Next one is a tax to GDP ratio. What is the understanding of tax to GDP ratio? How much is the total amount of taxes collected, direct as well as indirect taxes, divided by the value of final goods and services produced in a country, tax to GDP ratio. And what is the importance of tax to GDP ratio? Higher is the tax to GDP ratio. Remember this. If your tax to GDP ratio is higher, it essentially means you are covering more of the market and collecting more amount of taxes. And what is the use of it? If you are able to collect more amount of taxes, your dependence, I repeat, your dependence on market borrowings would be lesser. Your dependence on the market borrowings would be lesser. That is the importance of tax to GDP ratio. In fact, in the current affairs, tax to GDP ratio has appeared in the context of direct taxes, indirect taxes, even the concept of tax buoyancy has appeared. And earlier we have discussed the idea of a tax buoyancy. It measures, it is also a ratio. It measures the change in the taxes collected divided by changes in the GDP. That is basically the concept of a tax buoyancy. Please remember that as well. Interest coverage ratio, the last type of financial ratio, interest coverage ratio. In fact, there is one more, debt service coverage ratio. But anyways, interest coverage ratio or interest service coverage ratio, it represents the ability of the company. What is the interest coverage ratio give you? It represents the ability or the capacity of the company to meet its current interest payment liabilities. Current interest payment liabilities. And how do we calculate it? There is a term called as EBIT, earnings before interest and taxation, divided by interest payment. In fact, please understand, in addition to interest coverage ratio, there is also one more ratio, debt service coverage ratio. And the formula is similar, not the same, it is similar. There will be a slight change in the numerator and the slight change in the denominator. Reason being, whenever you use the term debt, imagine you have borrowed a loan, you have taken a loan from a bank, you will pay interest, but when you pay interest, that is, let's say EMI, along with the interest, you will also keep on paying certain principal amount. So, in case of debt service coverage ratio, DSCR, the denominator will be interest plus principal payment. So, debt service coverage ratio slightly different, but again the logic is same. How much is the capacity of the company? What is the capacity of the company to repay existing loans? And I hope you understand, if your interest payment liability is, let's say 10 rupees, and if your earnings are, let's say 100 rupees, does it not mean you have 10 times the capacity right now? I hope you understand. I'll repeat the numbers. If your earnings is 100 rupees and your interest payment liability is 10 rupees, what does it mean? You have 10 times the capacity to pay the interest. So, higher interest coverage ratio is always preferable. It is used as an indicator of stability in a company. It has more amount of money now to repay the interest. And if your interest coverage ratio keeps on decreasing, that is, let's say it falls below 1, it simply means you do not have sufficient capacity to even repay the interest amount. And this is there in the newspaper. Remember, there is a term called as zombie firms. In the context of the term zombie firms, the idea of an interest coverage ratio and debt service coverage ratio was actually discussed. If your interest coverage ratio falls below 1, it's very dangerous. You do not have sufficient amount of earnings to pay your interest liabilities. And those companies where ICI generally will fall below 1, these are called as zombie firms. Remember the terminology. Essentially, these are the companies which are existing, but they do not have sufficient capacity to take care of their liabilities. What is the importance of this? Higher interest coverage ratio is always preferable. Now, these are different ratios. Again, is it the complete list of the ratios? Certain ratios are there in the static portion. I have not touched them. For example, there is a ratio by the name of capital output ratio. Please go through that. Capital output ratio. Where? Sir, where do I come across capital output ratio? Planning. Right? That is basically talks about efficiency of the capital invested. How much money or how much capital you should invest to get 1 unit of output is called as capital output ratio. There is also incremental capital output ratio. Incremental capital output ratio. How much should be your additional investment in order to get 1 additional unit of output? Additional capital required to get 1 additional unit of output. And essentially, if you look at both of these, you will realize that the ratio should be lower, right? Both of them should be lower, right? So these are some of the ratios. In fact, CRR, cash reserve ratio, we have discussed in earlier classes. Statutory liquidity ratio. The banking ratios are really very important because we have discussed earlier in the Conquer Prelims, static as well as the dynamic portions. I am not covering them now. Now, going forward, what is this concept of Lorenz curve? I have given you multiple types of curves now, graphs. Let's go one by one. Lorenz curve. Lorenz curve is generally used to represent inequality. And in the last 1.5 years, there is a lot of discussion regarding rising inequality. If at all there is a rising inequality, there is a lot of discussion in context of India. K-shaped recovery, V-shaped recovery, the income inequality, right, or wealth inequality reports, etc. In that particular context, suddenly the concept of Lorenz curve becomes necessary. What is a Lorenz curve? It provides a representation of income inequality or wealth inequality in a society, that is in a country. And you can use this concept of a Lorenz curve to understand whether the inequality has improved over a period of time. Improved in the sense, has it come down over a period of time? How is India performing in terms of inequality, reducing that compared to, let's say, USA, etc. So, Lorenz curve representation is very simple. You need to draw a square box, and this line will represent perfect equality line, perfect equality curve or line. Along x-axis, you will represent cumulative households. Along y-axis, you will represent cumulative incomes earned by the households. And if the curve of a country falls very far away, I hope you understand. If the curve of a country falls very far away from the perfect equality line, it simply means inequality in such a country is very high. If the curve of a country moves very nearer, very close to the perfect equality line, the inequality in the country is actually reducing. That is the indicator, that is the meaning. In addition to this concept of Lorenz curve, using the curves or graphs, there is also the term Gini coefficient. Remember this, there is also a term called as Gini coefficient. Right? What is the importance of Gini or Gini coefficient? Pronounce it either as Gini or Gini, doesn't matter, concept is important. Gini coefficient is also used to represent inequality in an economy or inequality in a country. For example, how do we calculate Gini coefficient? If I mark this, right, imagine this is perfect equality curve and this is the curve of a country. I will find out how much is this region, what is the area of this region, and I will also find out what is the area of triangle ABC. What is the area of the triangle ABC? That is basically this region divided by this complete triangle, right, area of complete triangle, and that will give you Gini coefficient. And if the inequality in a country is coming down, which also means the area between the perfect equality as well as the curve of a country, that area is also coming down. So if the Gini coefficient keeps on reducing, it is a symbol, it is an indicator of reducing inequality. That's the reason the two extremes in a Gini coefficient are 0 and 1. Done? So this is the importance of Lorentz curve. Be very careful. Lot of discussions happening in the context of equality, inequality, rising, reducing, etc. in the context of India. In fact, when the HCES, Household Consumption Expenditure Survey, very recently, the latest data is published. There also the concept of Gini coefficient is being discussed. Next one is Phillips curve. What is the importance of Phillips curve? Phillips curve provides an inverse relationship between unemployment rate and inflation rate. It provides an inverse relationship between unemployment rate and inflation rate. That is basically, according to this particular curve, whenever the inflation rate is higher, unemployment is lower. Whenever inflation rate is lower, unemployment rate is higher. How is that possible? Whenever the growth rate is higher, inflation tends to be higher, and when the growth rate is higher, it simply means production is higher, employment would be higher, which also means unemployment rate would be lower. So vice versa, use the opposite situation, you will get the meaning of the opposite side as well. That is low inflation rate, high unemployment rate. So this is basically the concept of the Phillips curve. Is it applicable in all the situations? Absolutely no. Earlier we discussed the concept of stagflation. In earlier classes, we have discussed the concept of stagflation. In the context of stagflation, what happens? The growth is not happening, economy is stagnant, inflation rate is very high. That is the situation of a stagflation. So economy is stagnant, the inflation rate is very high, unemployment rate is also very, very high. That is called as stagflation, which is an exception to the concept of Phillips curve. And post 1970s and 80s, there has been lot of theories which have disproven the idea of a Phillips curve. For that, you do not have to be worried. Focus only on the basic concept of a Phillips curve. What is the inference? Use it if at all a question is asked in the preliminary examination. Next one is the Laffer curve. The concept of Laffer curve. Laffer curve is given by Arthur Laffer. Arthur Laffer. And what is the concept of a Laffer curve? It provides a relationship between the tax receipts collected by the government with the tax rates imposed by the government. The tax rates is correlated, is connected to the tax receipts collected by the government. And the Laffer curve, please remember, is an inverted U curve. It is an inverted U curve. That is basically U written ulta. That is opposite. Inverted U curve, that is a Laffer curve, which essentially means as the government keeps on increasing the tax rate, the tax receipts will keep on increasing, but beyond a certain tax rate, which is called as a threshold tax rate, optimal tax rate, threshold or optimal tax rate, beyond a certain tax rate, if government increases the tax rate further, the tax receipts will not increase, rather tax receipts will decrease. The argument is simple. If the tax rate is increased beyond a certain level, the taxpayers will feel the burden of it. And because they feel the higher tax burden, they will start replacing with leisure, that is work with leisure. Production will come down, that is their work days will come down, earnings will come down, the payment of taxes will also come down. That is basically the concept of Laffer curve. Important for preliminary examination, please be very careful. Now, if UPSC will ask you, there is a way to find out optimal tax rate. Under the Laffer curve, there is a way to find out what is the optimal tax rate. Answer for that is wrong. Right? No, there is no way to find out what is the optimal tax rate. In fact, Government of India multiple times has reduced the tax rate, assuming that the amount of taxes collected would be higher. It has done very recently back in the 2019. But please understand that tax receipts collected are not the function of only the tax rate. Multiple, let's say, events will have an impact on the amount of taxes collected. Done? So this is the idea of a Laffer curve. Next one, Kuznets curve. Kuznets curve. And by the way, Kuznets is basically Simon Kuznets. And those who are wondering, sir, why are you giving the full name of Simon Kuznets? Simon Kuznets is that economist who gave you the idea of a GDP, concept of GDP, your favorite one, gross domestic product, the three methodologies, etc., etc. the concept of GDP was proposed by Simon Kuznets. Remember it. Now, what is this Kuznets curve? Kuznets curve basically talks about inequality, the development, growth as well as the inequality in an economy. The representation of Kuznets curve is somewhat like this. That is, along the y-axis, you will represent Gini coefficient. You will represent Gini coefficient along y-axis, and you will represent the gross national product per capita. Gross national product per capita at PPP, purchasing power parity basis, along the x-axis. What is the argument behind this? The argument behind the Kuznets curve is that whenever the economy will shift, whenever any economy will shift from agrarian society to industrial economy, the inequality will start increasing. But post industrialization, that is, the economy will reach a particular point. Post this industrialization point, the inequality, rather than increasing, will start reducing. This is the idea of a Kuznets curve. I'll repeat it again. What does a Kuznets curve basically mention or discuss? The economy, whenever they will shift, or a society, whenever it will shift from agrarian society to, let's say, an industrial society, the inequality will increase. And some of you will ask me, sir, why? Why do you think the inequality will increase? Reason being, in agriculture sector, there is no scope of huge income inequality because everybody is involved in agriculture sector. The skill sets required are almost similar. The amount of, let's say the profits which are earned or the incomes earned are very, very close by. So, inequality is very less when it is an agrarian economy. But when it will shift to the concept of industrialization, when the society will shift to industrialization, skill sets will come into picture. Investments will come into picture. And I'm pretty sure all of you remember the idea of a capitalism. The owner will take away the profits. So, the inequality, when the society will shift from the agrarian to the industrialization, inequality will start increasing. Now, some of you will ask me, okay, agreed. But why do you say that after a certain period of time, inequality will come down? That happens because, understand this very carefully, it happens for a very simple reason. After a certain time period, post-industrialization, let's say, service sector will start booming. Education, quality education is available to people. Right? Let's say, occasional training is available to people. So, people will start acquiring themselves with certain services now, and they will be able to earn more amount of income, which will basically reduce the income inequalities that are existing in the society. That is the curve which is provided, which is basically called as a Kuznets curve. Done? So, these are the various concepts that I wanted to discuss in the context of ratios as well as the curves. Beyond these particular curves, any other curves or any other ratios are needed for civil services, please revise the following. In the context of employment, unemployment, in the context of employment and unemployment, there is a name, Nobel laureate now, Claudia Goldin. Claudia Goldin has provided a concept called as U-curve theory. Right? She has proposed something called as a U-curve, which discusses what has happened to the women's employment and unemployment situation through ages. Not in the last 10 years or 15 years, through decades, right, in the global market, especially targeting USA. UPSC can suddenly pick up a question from that particular area. Please be very careful. U-curve is important. Within microeconomics, the supply curve as well as the demand curve. In the last 3 to 4 years, no question has come from microeconomics. Please be very careful. Suddenly, UPSC can pick up a question from there. Supply and demand curve. And connected to supply and demand curve, the concept of market equilibrium. Concept of market equilibrium. That's also equally important. Idea of a market equilibrium, curve related to market equilibrium. Right, so these are some of the important ratios as well as the graphs or the curves that I wanted to discuss with all of you. I hope this particular class has been beneficial to all of you. If you have derived certain value, please recommend these classes to your friends as well. Again, reiterating my point, there are multiple ratios. Is it possible for a civil services aspirant to remember all these ratios as well as the graphs? I don't think so that is required. But based on what has been in the discussion in the last 1.5 years, these are the important ratios as well as the graphs that you need to have a look at. So please recommend these particular videos to your competitors as well. Revise well. All the best. Right. See you again when we will have the discussion of the question paper. Thank you. Have a great day.